All right, Prashant Khemka joins us, founder with WhiteOak Capital. Prashant, good morning. Thank you for joining us. What is your sense, Prashant? I mean, the world is adjusting to high inflation and high interest rates. Do you think adjustment is over or it is still left?
Good morning. Thanks for having me here on the show. It is very difficult to say. I mean, when you are in such strong flow, it's very easy to say that we are still adjusting and there's long way to go. But it is very difficult to say whether we've overdone it from a long-term interest rates perspective. Obviously, the near-term interest rates are a given that they would be rising materially higher, as that has been orchestrated very clearly by the Fed and central bankers. But what really matters for the market is how much is already anticipated by the markets, and what do the longer-term rates do, the 10-year, the 30-year. And that is not possible really for anyone to say at this time where they would ultimately settle. And the same is true for the longer term commodity prices beyond the next 6 to 12 months. The spot prices are driven by what the current near term supply demand is suggesting, but the longer term commodity prices will be more a function of how the supply chains normalize. The supply chain normalization from COVID itself was fraught with a lot of unpredictabilities. On top of that, we now have the geopolitical situation in Europe with Russia, Ukraine, which is a supply shock where it is very, very difficult, not clear. Anyone knows when that would stabilize and what kind of sanctions would be there and how long they would last, because they would have a bearing on the supply chain and hence the commodity prices. So those two remain, variable: the Fed or the longer-term bond yields, as well as the commodity prices.
For the longest time, Prashant, you've advocated that you want to go for companies which generate a lot of cash, which are enjoying some degree of pricing power, largely FMCG, consumer-facing names. But given how interest rates are moving higher, how commodity pressures are visible, margins will remain under pressure, is it time to rethink it?
So what you mentioned are maybe more of characteristics of the companies that we own. Some of the characteristics of the companies that we own, as they are more of a byproduct of the team's philosophy. So you mentioned three aspects or attributes: cash generation, consumer facing, and one more that I forgot. But basically, what we look at is companies that generate superior returns on capital. So superior returns compared to cost of capital, which, as any businessman or any investor would tell you, that's a prerequisite to cash flow generation. And second is scalability, which is growth, whether those cash flows can grow substantially. And third is good management, execution, as well as governance. So these three are the attributes that the team looks for, as they are rooted in the fundamental value equation. That is, value of any business is present value of future cash flows, right? And then the things that you mentioned, cash flow generation and pricing power, I think was the other one. These may be the byproduct of these fundamental attributes that we talk about, and these principles, fundamental principles or attributes, I would say, are very core to investing, and they don't necessarily change with they may, the nuances might be there on how we assess these attributes over time, but the core principles haven't changed in the last 2+ decades that I've been professionally managing money, as they are, as I said, most basic, most core to the fundamental first principle, which is that value of any business is present value of future cash flows. And at this time also, that hasn't changed.
Right. Prashant, hi, morning. I'm wondering how worried are you about the prospects of FMCG? I mean, as though input cost pressures weren't enough, there's another blow this morning. Indonesia has banned the export of palm oil from the end of the month.
Certainly. So these are concerns from the very near-term perspective. This year's the commodity price increases this year or next year might dent, as we've seen with some of the early reports that have come through, might dent the margins of leading FMCG companies. But sorry to harp upon it. Few things. First of all, from a risk management perspective, we as a team always advocate and have a balanced portfolio construction approach. So we would never have a portfolio full of only FMCG companies or a portfolio that has zero FMCG companies. We consciously do not take top-down calls. We would identify as a team the best of the FMCG companies, the best of the financial companies, the best of the IT services companies, and have a good balance across all most of these various sectors, unless there are some sectors where we do struggle to find companies that have any of those attributes that I talked about earlier, the superior returns, scalability, and good management. So having a well-balanced portfolio means you would have some FMCG which do get hit over a short period of time. And you would have, on the other hand, a sector like financials, which might do well at the same time. And between the two, they balance your risk, sectoral risk. But what you are counting on, really, so we are not like neutralizing or hedging the portfolio completely to whatever is the market, but what you're counting on is that you own the best of the FMCG companies and the best of the financial companies, such that the financial companies outperform the financials in the market and the FMCG companies outperform the FMCG in the market, and the two combined together in the portfolio will outperform the market. So that's the balanced portfolio aspect. And then FMCG in particular, yes, in a given year they may face a hit, but market is a long-term discounting mechanism, and my experience has been not just in India but globally, in times of high commodity prices, the well-established FMCG companies tend to, more often than not, if not always, gain market share from their weaker competitors and the mom and pop or unorganized sector competitors, as these larger players are much better suited, adept at passing on price hikes and also absorbing the working capital hit.
That's quite interesting, Prashant. So, I completely get your point about having a balanced portfolio, and FMCG is a must-have indeed. So, what is it that you're going to be doing in this current decline? Add more positions to your to the top FMCG players, or stay put as is?
So sometimes the best course of action is to do nothing, especially if you've started with a well-balanced position. As we often say, the best positioning is that does not require repositioning. So if you started with a balanced portfolio, which means you have adequate amount of FMCG compared to what it is as a basket in the market, then you don't necessarily have to, with this ups and downs in the stock prices, don't have to touch or change that necessarily from a risk balancing perspective. Having said that, markets at an individual stock level is more volatile than at an aggregate level. And if we find that certain particular companies that we have tended to like anyways are beaten up more so than others, then there can be reallocation, and all the time the team does reallocate capital from one company to another where they see better value has emerged and fundamentals are just as strong as we've always found them to be. So there is movement within the portfolio and within the FMCG sector that the team might do. And we're not fixated on exactly maintaining or increasing at the overall level. As long as from an individual company level, we see opportunities to buy or to trim, we would go ahead and do that.
Good morning. This is Nayantara joining in. When you talk about the changes and portfolio balancing, can you share with our viewers some of the material changes that you have made to your portfolio?
Certainly, Nayantara. Obviously, can't go into specific names, but if you were to look at, say, over the last year-to-date period, 3 months, 4 months period would be a reasonable time frame to talk about, or over a 12-month time frame, Nayantara?
I was hoping shorter term, but sure, okay. Go ahead.
So let's say over the last 3 months, we have added to, as a team, we've added, let's say year to date, some of the automobile and auto ancillary automobile, overall generally auto sector names. We've added to consumer discretionary, while auto also falls under consumer discretionary, but more broader consumer discretionary names, which may include retail, as an example, and other consumer discretionary items. We've also added to metals selectively, partly from a risk management perspective, but some metal names have also been added to the portfolio. We continue to have very healthy positions in some of the largest sectoral positions in portfolio continue to be private sector financials and IT services, technology services.
Okay. Prashant, where does IT fit in? Growth of 12 to 14% and valuations of 25 plus with a wage pressure. What happens to that sector?
So IT is still, from a valuation perspective, the most attractively valued sector because what you talked about is PE multiples. We don't look at PE multiples at all. As I mentioned before, they are distorted, misleading, and harmful if used for decision-making purposes. What we focus on is cash flow-based valuation approach. If you look at the adapted or modified cash flow metric that we use, which we call OPCO multiple or excess price to excess ROIC multiple, the market today is trading at 40 times, okay, compared to the P multiple of Sensex, which is 23 times. On this metric, the market is trading at 40 times because the cash flow generation for the market as a whole, on average, is let's say at an average level by definition. But there are certain sectors which bog it down, and certain sectors like IT are far superior than the market cash flow generation, particularly excess ROIC cash flow generation. So the IT sector, if I were to take as a whole, is trading at around 30 times on this metric, less than 30 times compared to market at 40 times. So the P multiple for IT is maybe high 20s compared to 23. But because of the cash flow characteristics, the market is trading at 40 times compared to IT multiples, which is more like 30 multiples. So to us, from a valuation perspective, IT sector is probably the most attractively valued on a price to excess ROIC multiple. Then you can talk about growth, whether the growth is good enough. Is the growth going to be so slow that it merits such a big discount? If you look at IT services sector, people get carried away, or people are get misguided by what these companies and NASSCOM talk about is dollar growth. So these guys talk about longer term high single digit dollar growth rate. High single digit is not appealing to anyone in India. People take double digit mid-teens for granted, but high single digit at an industry level, high single digit dollar growth means low double digit rupee growth and at an industry level. And within that, the companies we own, we expect to substantially outperform and grow more at mid-teens. So regardless of whether it's low double digit or mid-teens over time, top line growth, very few industries or sectors in India at an overall sectoral level can claim to have historically delivered or can claim to going forward be able to deliver double digit growth. The overall GDP is growing at low double digits, about 10% or right. And hence the growth is superior to the average, and the valuation is one of the lowest in the marketplace, I would say. On the metrics that we talked about, which is cash flow.
That logic with cash flow, then metals and commodities will have serious cash flows this year and next year and hopefully in FY25 as well. Where does that fit in?
Absolutely. So see, it's cash flow plus growth and obviously the management execution. So the challenge with metals is growth is very challenging. Over a longer time period, these guys grow more or less in line with, or barely in line with globally GDP growth, which is 1 to 2%, and add inflation on top of that. So you can say 3% would be the longer term dollar growth, and then rupee growth would be mid to high single digit. So you have to adjust for when you look at the valuations or multiples, you have to adjust for the growth being more subdued. Obviously, growth can come from capacity additions, but if you factor in capacity additions, then the cash flow goes for a toss. So unlike IT services where cash flow growth, cash flows are 90% of the earnings through the cycle or more for IT services convert into cash flows. FMCG is probably the only sector which converts similar amount of earnings into cash flows. Metals through the capacity additions cannot convert that much earnings into cash flows. But the key reason for metals to trade at a much lower multiple, besides the cyclicality, is the very low growth that you see there. And also, I would add, at a complete overall sector level, the governance level of IT services sector is far superior in India and many places otherwise in global emerging markets that I've looked at for a variety of reasons. The governance of IT services sector is far superior than the governance at an aggregate sector level. I'm talking about some of these metal companies are very well governed as well. At the aggregate sector level, the governance of a metal sector does leave room to desire for more compared to that of IT services sector.
Okay, all right, Prashant. Really appreciate your time and thank you for joining us. The markets have recovered marginally from the day's low. It's not like we have fallen in line with what's happening in global markets. We've outperformed. We've done well this year on a relative basis, on an absolute basis. Are we likely to go against the trend? That is a question which we'll be addressing. But today, the bottom line is it's a bad day of trade. You may call it Monday blues. You may call it the global risk off moment.